Hi, welcome back. I haven't talked about valuing individual companies for a while, and I've been itching to go. I really wanted to get back to valuing companies rather than talk about markets and data. And I got a chance a couple of weeks ago when Spotify announced that it was filing a prospectus for an IPO. In fact, there are two big unicorns that have announced IPOs. The first, of course, is Dropbox, a storage solution for those of us with these gigabyte files that we don't know where to put. And the other, of course, is Spotify, which is a music streaming company, a high-profile company. Partly because of the potentially high market cap that people are attaching to it, and partly because of the strange structure of Spotify's IPO, and I'll talk about it for a moment, I wanted to focus on Spotify in this session. So let's take a look at what Spotify's done. It's caught a crest and perhaps even created a crest, a change in the music business. To see how the music business has changed, take a look at this graph where I look at the total revenues for the music business and where the revenues came from. In the late 90s, the revenues came from physical sales, records, CDs, and you can see that almost all of the sales are from physical sources. As you go through time, you'll see that the digital portion of those sales have increased each year, and you also have sponsorship rights or other ways of creating revenues. There is, though, overriding bad news in this graph for the entire music business, and that is the total revenues in this business have shrunk by about a third, from 24 billion down to about 16 billion over this 18-year time period. So the business has changed away from the old music stores selling CDs and records to digital downloads and then to streaming. And along the way, the music business seems to have lost revenues as it went along. The only good news here for the business is in the last couple of years, you've seen a tick up in 2016 and 2017. And maybe the music business is figuring out a way to live with the new reality, which is the way people get their music is different now than it was 10 years ago, 20 years ago. Spotify has positioned itself for this shift in taste and the way people buy music. So let me describe the basic Spotify business model for those of you who don't have Spotify. There are two ways you can subscribe to Spotify. There is a free version of the model where you pay nothing every month, but you get very limited customization. You essentially can't create the kinds of playlists and stations you can in the premium version, and you have to listen to ads. Then there's the premium version where you can create a lot of customization. You can create playlists that reflect your preferences and the time of the day you listen to music, as well as no ads. Now, the premium service costs money, and how much does it cost? In the US in 2018, if you bought the Spotify premium service, it costs you $9.99 for a standard service. But a little while ago, Spotify also introduced a family subscription where up to 6 people in a family can share a Spotify account. They can each have their individualized playlist, but they can all pay $14.99 and get the entire family under one umbrella. We'll come back and talk about this because this has had consequences for Spotify's revenues. The pricing for Spotify, which is a Swedish company, it was founded in 2008 in Sweden. It's actually not the first player in this game. Pandora and SoundCloud preceded it, but to show you that the spoils always don't go to the first movers, Spotify is bigger and more successful than either of them. The pricing that Spotify uses across the rest of the world is different from the US. Prices vary from a high of almost $17, so I've converted everything into dollar terms in the UK, down to much lower prices in Latin America and Eastern Europe. Now, the way Spotify pays for its music is it pays based on whether you listen to a song. So the more times, it pays per stream of a song. So if a song is played a lot of times, the label/artist gets money for that song. So it's based on how much people listen to a song, which makes it a little different than the Netflix model, where Netflix actually buys content or makes content, and then the more people, and it's actually not per person watching a movie that determines how much you pay the makers of the movie. So that's a basic Spotify business model. Let's talk about some of the things you can learn by looking at the Spotify prospectus. And I'd strongly recommend that you take a look at the prospectus to make sure I haven't screwed up or biasing the numbers in any way. First, let's start off by accepting the obvious. Spotify is a growth company. Its revenues have gone from a little less than 2 billion euros to almost 4.1 billion euros. And over that period, the number of subscribers has also increased from about 90 million to about 160 million. The composition of the subscribers has changed as well, with more premium subscribers. About 45% of the subscribers in 2017 were premium subscribers. That number was 31%. So there's been growth in revenues, growth in subscribers, a shift away from free subscribers to premium subscribers, and in a minute you'll see why. If you look at where Spotify gets its revenues, it gets 90% of its revenues from its premium subscriptions. The remaining 10%, and that 10% has stayed about the same every year for the last 3 years, has come from advertising. If there is one discordant note in the numbers, here's what it is. It is true that Spotify is growing its revenues, it's growing its subscribers, it's growing its premium subscription. But what it's collecting per subscription has dropped over the last 2 years from a little over €7 to a little less than €6. If you ask Spotify, their explanation is it's because of the family subscriptions, but that is their explanation. This is something that needs watching, because obviously it's not just how many subscribers you have, but what they pay per subscription. Now let's talk about content costs. In fact, the most optimistic component of Spotify's numbers over the last 3 years is content costs as a percentage of total cost has decreased over the 3 years from almost 90% to less than 80%. There is, however, a tension here between what Spotify will tell its investors and what it's telling labels and artists. Because remember, these are what Spotify pays for content is what goes to the artists and the labels. And there are some big name artists who have pulled out of Spotify, arguing that Spotify and streaming in general is not paying artists well. Taylor Swift and Jay-Z, for instance, are no longer on Spotify. But the content cost coming down is in fact the most optimistic component for investors, but it might not be good news for labels and artists. Okay? Now let's talk about the other costs. And on these other costs, you have 3 big components. You got R&D costs, you got marketing costs, and you got general and G&A costs. These costs are not just big, they're getting bigger on percentage terms. As a percent of revenues, if you look at R&D costs, it's gone from 7% to almost 9.7%. Marketing costs has gone from almost 11% to almost 14%, and G&A costs has gone from 5.5% to 6.7%. You're saying, so what? This is not the way economies of scale are supposed to work, right? The cost might get bigger, but as a percent of revenues, it's supposed to get smaller. But that's not what's happened in these 3 years. I mean, of course, the 3 years might be an aberration, but something to keep in mind as you craft a story for Spotify. So here's what we know about Spotify looking at the prospectus. It's grown. It's getting more premium membership, less advertising driven. Those premium members are paying a little less per person than they used to 2 years ago. The content costs are going down, but the other costs are going up. And the overall operating income is a loss, and the loss has actually, as a margin has decreased, but the operating loss is pretty substantial still. So with that in place, let's look at the IPO structure and what's interesting or different about the Spotify IPO. In most IPOs, the offering company finds an investment banker who then creates a syndicate, and the investment banker does multiple things on the IPO. The investment banker prices the IPO, sets an offering price, guarantees that price, then uses that syndicate of other banks to market the offering. They do road shows and client pitches. So that's a traditional IPO. Spotify is not going to use bankers. It's actually going to let the market price it based on demand and supply. Saying, oh my God, that's dangerous. We'll come back and talk about it. It's a lot less dangerous than it looks. Second, in most IPOs, when a company does a public offering and gets proceeds on the offering day, it issues 1,000 shares, 1,000,000 shares, 10 million shares. The proceeds from that offering usually go to the company, and the company either uses it to pay off past financing that doesn't have good terms, or most of the time just keep the cash in the company to cover future investment needs. After all, it's a growth company, needs money for the future. This allows you to get that cash up front. Spotify is not going to do any of those things. It's going to issue shares, roughly, by its own estimate, about $1 billion worth of the shares are going to be issued in the offering day, but the entire billion is going to leave the firm. You're saying, go where? Well, some of the existing investors in Spotify are going to cash out. So unlike most IPOs, the cash is going to leave the firm, which actually makes it easier from a valuation perspective, but raises a few red flags, as we will see as investors. So here are my thoughts about the twist. Am I concerned about not having a banker? Not very much, especially for a company like Spotify. I think the banker role in IPOs is vastly overrated. They don't value IPOs, they price them. How do they price them? They get on the phone, they call, investors and say, what would you pay for the company? So since Spotify has already had a pretty active private share market, the pricing done by banks is not that important. You're saying, what about the guarantee? Well, here's what banks do. They guarantee a price, but they set the price about 15 to 20% lower than what they think a fair price should be. Hey, you set the price 15 to 20% low. Of course, you can offer me a guarantee. And for this, you ask for an underwriting guarantee fee. And finally, the marketing that banks do is, I'm not sure that there's much marketing that goes on. It's more gauging of demand. And I actually come out of road shows knowing less about IPOs than often when I go in. So no bankers, I can live with that. But the fact that the proceeds are leaving the company trouble me for two reasons. One is that means there are equity investors who want to cash out at the time of the IPO. Why? Because they don't feel as optimistic about the future of Spotify as Spotify itself is telling investors they should feel. That's my first concern, is there's a cashing out. The second concern I have is there's a control issue, which is when you cash out, the investors who are the most vocal, who disagree the most with the existing management, are the ones who are going to cash out. And given the structure of this IPO is going to have voting shares and non-voting shares, this seems to actually kind of make the founders even more in control of Spotify than they were before the IPO. And that concerns me because to the extent that they lead the company down the wrong path, there's nothing to stop them. So the IPO, the way it's structured, no banks doesn't bother me, but the fact that the cash is leaving the company does bother me a little. So let's talk about valuing Spotify. So I'm going to tell you my Spotify story. The key word is my. Your story can be very different. So in my Spotify story, I see continued growth, albeit at a lower rate. And here's why. Spotify can't keep growing at 50 to 60% a year for two reasons. One, it's scaling up. It's a much bigger company than it was 3 years ago. Second, it's got some intense competition, especially in the US from Apple Pay. This is a company, Apple is a company with $250 billion in cash, deep pockets. It can keep throwing money at this business for as long as it wants. And within the US, Apple Pay's growth has already cut into Spotify's growth. So I'm going to bring the growth rate down. I'm still going to give them a healthy growth rate because they've got global growth to look forward to of 25% a year. Much of this growth will come from the growth in subscribers, but I'm also going to assume that the drop in per subscriber revenues we saw in those 2 years has leveled off, and that now you've got the family memberships out there. You shouldn't see that number continue to drop, but I'm going to keep my eye on it. I'm also going to assume, and this is tricky, that the content cost, which has come down in the last 3 years, will continue to go down. In fact, Spotify's pitch to investors is they can increase their gross margins to 30 to 35%. What does that mean? That effectively means that content cost is going to drop to 65 to 70%. I think that's going to be tough to pull off, but I think Spotify can point to the numbers in the last 3 years and that we can do it. So I'm going to give them the benefit of the doubt and allow the content cost to come to 70%. But I'm going to be watching how they maneuver through this, keeping investors happy and artists happy at the same time, because that tension is going to rise to the surface. So let me bring these together in what I think will be the key variable that determines what value attached to Spotify. Eventually, Spotify's value will come from their steady state margins, what kind of operating margin you will see them having as a company. As I said, I'm assuming that content cost, which was 79% in 2017, will continue to go down over the next 10 years, down to 70%. That's not going to be easy to do, but it's doable. I'm also going to assume that marketing costs are going to come down simply because if growth comes down, you don't need that much marketing. The tricky part is you need economies of scale to kick in on R&D and G&A. Not that they won't have to spend more money. I am assuming they will spend a lot more money. But as a percentage of revenues, I expect those numbers to drop to about 6% of revenues. If those predictions come true or are reasonably close to estimates, the operating margin I'm looking at, and this is pre-tax for Spotify, 10 years out is about 13%. That's going to be a key number driving value, but it's built on my assumptions about what happens to costs. Now, I'm also going to make some additional investments that drive my Spotify valuation. Spotify is a business built for scaling up. from the way they pay for content to how they reinvest, this is a company that should be able to get lots of revenues with relatively little capital investment, mostly in R&D and acquisitions. So I'm going to assume that they can get about $4 of revenues for every dollar of capital invested, which would put them at about the 90th percentile of global companies in terms of how much revenue they get per dollar of capital. I'm also going to assume that the company, in spite of being a young growth company, has manageable operating risk because it's built on a subscription business. Subscription businesses tend to be driven by inertia, which means people are reluctant to cancel subscriptions unless they have to. So it actually, the fact that they have 90% of the revenues come from subscriptions and that there's stickiness here, users tend to continue as users, means that that portion of the revenues is going to be pretty predictable, which is part of the reason when you look at the cost to capital I'm giving Spotify of 9.24%, it's not sky high. It is higher than most companies. It's the 80th percentile, but it's not at the 95th or the 99th percentile. But here's the catch. Spotify is still a big money losing company. It faces, in Apple Pay, and perhaps, who knows, Amazon Music or Netflix Music, potentially big players who could enter this game and squash them. And I'm going to assume there's a fairly significant chance still that that can happen. I mean, there's nothing that Spotify's done that guarantees that they're going to continue as a going concern. I'm going to assume there's a 20% chance that Spotify, in fact, runs into a brick wall. And if that happens, I assume somebody will buy them, but only pay them half of their going concern value. So that's pretty much it for the valuation. Here are the loose ends. I add the cash balance that Spotify has, which at the end of 2017 was about €1.5 billion. They do have about 20.82 million options and warrants that are valued as options, as live options, and I'm going to subtract out the value of the options. Their share count that I use doesn't include the options because I'm subtracting out the value of the options, but it includes the regular shares and the restricted shares, 177.17 million. And the value per share I get when I tie up those loose ends of adding the cash balance, netting out the options, and dividing by the share count is about 88.26 euros, or about $109 per share. Now remember, this assumes that all shares are equivalent, and given that the share structure is going to be voting and non-voting, you might attach a bit of a discount. How much of a discount will depend on how much you like the founders of Spotify and how much you trust them. The more you distrust them, the more of a discount you would attach. So if I were to bring my entire story together, and this picture kind of captures it, it connects every one of my assumptions. The 25% revenue growth comes from my story of Spotify continuing to grow but facing headwinds, A, from scaling up, and B, from players like Apple Pay. Their operating margins improve to about 13%, and the story there is that content costs will continue to decline to about 70% of revenues in conjunction with economies of scale in R&D and G&A. I'm going to use a global average tax rate, not the Luxembourg tax rate or the Swedish tax rate of 25%. And I'm giving them the credit of the fact that they have 1.35 billion in operating losses that they will carry forward. So that shelters them from paying taxes till almost year 6. And the rest of the story reflects the fact that their cost to capital is not sky high. It's 9.24%, and as they mature, that will come down. And I'm attaching a 20% chance of failure. And the numbers are captured, as I said, give me a value of about 89 euros per share, or about $108 per share. Incidentally, the most recent private company transaction was a little higher. It was at about 108 euros per share. So I'm not saying that they're wrong. I'm just saying with my story, I can't justify paying that price. Now, there are things I've left out in this valuation that I will come back to. And there are 3 things. The first is, I've said before in my talks about IPOs of Twitter and Facebook and Snap and Alibaba, that IPOs are a pricing game, not a value game. And if you're going to play the IPO game, nothing that I've done in this session so far is going to help you that much because I've valued Spotify, not priced it. So in my next post, I'm going to come back and price Spotify. You're saying, what's the difference? You're going to find out soon enough. The second is there is this pushback you get when you value companies like Spotify that you cannot use what I just used, a top-down model where you start with revenues and work down to cash flows, that you really should be valuing users and building up. So I'm going to use a technique I developed last year to value Uber and Amazon Prime members to value Spotify from the users up. And it's going to be interesting to see what that value is relative to my top-down value. And there's a third factor, which is Spotify is learning what we like and what we don't like by our music choices from their premium members. And to the extent that they can use that data to tailor the music we listen to and perhaps even develop new music content to reflect user taste, who knows? That data could give Spotify a platform to sell other products and perhaps get back to, and this might be the thing that they can offer artists in return for lower royalties, is data that can allow these artists to sell more. In fact, make the music business go back on a growth path. All of these are interesting issues. Too much for this post to add on to this one. So I will come back and deal with all three in my next session. That's about it for the moment. And it'll be interesting to see what Spotify goes public at. Thank you very much for listening.